Hey everyone, it's Erich Reimer. I'm here today to discuss who wins amid volatility. The past few weeks in the global stock markets, global asset markets in general for bonds, etc., have seen immense volatility that has not really been seen since the 2008 financial crisis, or even before in many cases. And as the stock market goes up and down each day, with a currently net trend downwards, you may be wondering, okay, things go up and things go down, but who really wins amid all of that? The answer to that is people who utilize either strategies or financial assets in conjunction with those strategies that benefit primarily off of volatility. For example, if you buy, say, 100 shares of uh, Apple, for example, and you just hold on to it. And in a few months, the net price of Apple has gone up. Then the volatility of the day to day and the paper losses or paper gains in the meantime don't really affect you. And the only way it could affect you if it's used for collateral, such as if you're using margin or using your stock as collateral for a loan, for financial assets, balance sheet disclosures, like if you're applying for a loan somewhere as part of your assets, or in terms of the more theoretical opportunity cost. However, the day to day moves don't really affect you, only your entry point and exit price. For, of course, other assets, that is similar as well. However, let's go, for example, through some of the assets that are greatly affected by volatility, much more so than regular stocks. Firstly, are options. These are perhaps the most simple and common form of volatility playing. And so options are essentially where you have a contract, you buy a contract. One option usually obligates 100 shares of whatever underlying stock you're buying the option for. And you can buy a call, so that gives you the right to purchase 100 shares of stock at a set strike price. You can buy a put, which gives you the right to sell 100 shares of stock at that price. And the value of the option usually is a combination of the difference between the current price and the option strike price, if it's in the money, plus a time value. So, therefore, how long until the option expires, whether it's 1 day, 1 week, 1 year, 2 years. There's some really long options out there. Or in the case of an out of the money option, so like when the call option is for $30, but the current stock price is $25. And so in order for the option to be worth anything, you have to see it rise a few bucks. And then the value of the option at the moment is just the time value of it, which essentially is a mix of the actual amount of time and the market calculation about the likelihood of reaching that strike price between now and the option expiration. So options are a big market. You can make a lot of money very quickly from volatility, or also lose a lot of money very quickly, because on a day-to-day basis, you might see a stock, for example, move 5 or 10% on a dramatic day, but the options will easily move uh, you know, 20%, 50%, 100%, etc., especially as they go from uh, more far out from the current price to more closer to the current price. If there's that dramatic move, then they begin to kind of, in a singularity fashion, increase in price value as their strike prices become more realistic. So there's options. Another way is with volatility ETFs. And so there's several methods of these. For example, there's the VXX volatility ETF, as it is directly called. So basically, it's designed in a way through its contracts and whatnot track to track volatility. It's not meant to be a kind of item that's held long term, and so for those familiar with these futures contracts, ETFs, there's the rollover risk, and that definitely affects especially high volatility ETFs based on these financial instruments a lot, and so it's not meant to be held for any amount of time. It's meant to play on uh, daily volatility, intraday volatility, and it's correlated essentially to various VIX volatility indexes that track how volatile the actual day is. Another ETF method is through accelerated ultra ETFs. And so these basically are like, for example, linked to that hold a bunch of contracts for oil, for the S&P 500, for various usually broad active markets, so not for very specific ones. I haven't seen many for those, but for gold, etc. And so they essentially are designed to accelerate by 2 times, 3 times the movement in whatever direction for the moment those stocks are going in. So, like for example, if the S&P 500 that day is moving 2%, this ETF will move 6%. And there are limits set on how many multiplication factors can be allowed for these ETFs. The regulators set rules on those, but it can easily be pretty dramatic still in price impact, especially on a very volatile day. And as you can imagine, over time, these are definitely not meant to be held because they go wild and all over the place and are basically impossible really to try to approximate. Beyond that, there's most other volatility instruments are relatively complex. There's various exchange traded notes out there, and so these are not necessarily funds themselves. They are a form of debt issued by an actual issuer, and so it's linked to the uh, credit worthiness of that issuer rather than underlying assets in the case of an ETF. So exchange traded note can be govern under whatever rules they decide upon for the ETN, except these ETNs can be extremely volatile. They experience default risk because they're essentially a form of debt, often unsecured debt, and therefore they're really only for very advanced investors. And of course, with all these volatility methods, there's also ways of combining them. There's ways of combining options and different strategies so that as options move in certain directions, the net position uh, creates a different kind of risk that you're taking on. And essentially, in a turbulent market like the past few weeks for global markets amid coronavirus and now oil, as things move up and down, this is the way that many people undoubtedly have been making money, even amid this economic shakeup. And while these are not really strategies for, say, your retirement account, they're not even allowed really in many retirement accounts, um, they still are good to know, and especially for those out there who are trying their hand at the day trading or the day-to-day trading investment game. All right, so happy trading out there.